Chairman, the last several days, spoke fairly plainly about the need the U.S. economy has for accommodation, which means easier monetary policy, I guess, to most people. Do you agree with that? And if so, why?
Well, so I think if you look at the data about the U.S. economy currently, it's in a very strong position, right? Everyone's familiar with the unemployment rate figures, the lowest they've been in half a century. Current job production is well above what's necessary to absorb new entrants. Productivity measures is something that I've been very focused on and thinking about, both the current state of the economy and the evolution of the economy. Over the course of the last year, that's been materially higher. Productivity has been than it has been in a long time, and that's consistent with some of the things that I've expected. And so if you just look at the current data, it's a very strong economy. On the other hand, there are some significant risks out there, and part of our job at the Fed is to think about what are those risks. We've been calling them cross currents. Global growth is, the case for continued global growth is not as strong as the data around the United States, and that will have effects on us. Uncertainty about trade is also something that is having effects on business sentiment, the willingness of business to invest. And we've been seeing that at least show up in some of the data in restrained business investment figures over the course of the last year. So as a matter of risk management, as a matter of thinking about the course of policy, I'm not going to predict what we're going to do at the next meeting, which we'll decide at the next meeting with everyone gathered around the table and all of the views presented. But I do think that all of those are factors that will have to be taken into account, and especially those cross currents and risks will be something that we're factoring in.
So the reason I talked about both of your jobs is because I was asked a question this morning: what if the Fed gets it wrong, if it eases when it shouldn't be easing? And the first thing that occurred to me was we have excesses in the economy build up. And then it occurred to me, well, if excesses in the economy build up, then you're going to blame Randy. So I wonder how concerned you are about the possibility of getting policy wrong to the downside and concerns about excesses in the economy, in markets especially, building up.
So that's related to kind of the fundamental question of the relationship between monetary policy and financial stability risk, right? And it has become, I think, the most common view, and I share the view, that the best way to address financial stability risk is with financial stability-centric tools as opposed to monetary policy. I mean, a case can be made for the opposite view. I think Jeremy Stein would occasionally make the case for the opposite view. But on the principle of the right tool for the right purpose, I think that financial stability tools for financial stability risk are the right tools. And we have only a limited set of them in the United States. But then if you take that position, that evolves then into the question of, well, the principal financial stability tool we have in the United States, macroprudential tool, is the countercyclical capital buffer. So if we're, as a matter of risk management, if we're moving into a case where for risk management purposes, perhaps policy is going to be more accommodative, and maybe there's a potential for a mistake there, accepting your hypothesis, shouldn't we, as a matter of risk management, turn on the countercyclical capital buffer? That's a perfectly reasonable question to ask. When you look at the actual situation we find ourselves in, we consider financial stability and whether we risk quarterly at the Fed as part of leading up to an annual decision as to whether we'll turn on this countercyclical capital buffer, which is, for those who aren't steeped in all of these acronyms and technical lore, is a measure that will allow us to increase the capital requirements of banks at moments in the business cycle where we seem to be at the top of the business cycle, to allow us principally to be able to turn it down as we move then into a downturn of the business cycle. and therefore to stabilize, to cushion, if you will, the potential risk to the financial system of those sorts of boom and bust cycles. Give us an idea
of the magnitude of that, Randy. How much is the normal buffer, or how much is normal capital levels, and how much would they go up if you were to turn that thing on?
So the internationally agreed framework for this countercyclical capital buffer, has
nobody's put it in place yet, right?
Many countries have put it in place.
Oh, okay.
The Brits have turned it on and turned it off and turned it on again. So around the world, we have a reasonable amount of experience with this, and it could range from half a percentage point to a few percentage points, right? I mean, the view is that the relevant authority would come to a view as to what kind of an additional buffer is needed given the level of financial stability risk, and then would create that additional buffer with the ability to bring it down again as one moved into the bust part of the cycle.